All right. So the only thing is, I think what's going to end up happening is with the recordings, it'll probably end up being split into two pieces. The first 10 or 15 minutes of wasted time while we're waiting for all this stuff to cooperate will probably be split off and appear as a separate recording from this one. But um, I think we can dispense with the first part. This is the important part. So now that the computer is actually working again, we can go ahead and carry on where we left off. So let me just open the files that I was trying to use before, and then we'll get back to it. Okay, so what I would like to do then is get back and show you exactly what this technique is we're about to introduce and why it's so important. And I mentioned before, I think it's called value at risk, and it was invented about, let's say, 30 years ago. And it proved to be extremely successful and is still widely used to this day on Wall Street, but also at pretty much all financial institutions and many non-financial institutions as well. It's gotten much bigger and far outgrown its original purpose. So what we're going to know is how it works and why it's so important. So let's get back to chapter 10 real fast. So we're looking at chapter 10. Now, I wrote my own notes for this part, so I call it chapter 10 appendix value at risk. The slides that come with the book only have a brief mention of value at risk. I would like to get more deeply into it. And I'd also like to use some numerical examples that I made up, of course. Let me turn it off for a second. There we go. So there's the notes. Now I'm going to open up my appendix. The one I meant for this one to be used so I can write notes on it without affecting it. So and I'll be posting these later on. So this way, any notes that we do take, you'll get a copy of them. Here's the slides, and then what else do we need? Oh yes, we've got a very intensive Excel spreadsheet set up for these examples. So we'll be using Excel quite a bit tonight. So the file that you will be looking at is called Value at Risk Excel Example. And actually, I'm going to save this with a new name because I want to make it clear that we're filling in the details tonight. And again, when we're done, I can send this off to you. So we'll call this with solutions 4825. And then you can see there's a lot of details already here, but we're going to fill in the missing parts. And this will kind of stretch our memories of all of our statistical skills, I think. There's a lot going on here, as you can see. I've also included some formulas, so we don't have to keep looking at these slides to look for these formulas. So, so in the slides, we have, they mention at the beginning when they talk about transaction exposure, they showed us how to calculate the net cash inflows or outflows from all of these different foreign countries. And what they would have us do is calculate for these different currencies their volatilities, which means their standard deviations, and then correlations, which means how closely do these currencies track each other over time. All of that information can be combined into the special formula that we saw last week, which calculates the risk of the, in this case, two asset portfolio. So if we had two currencies that we were exposed to, we could use this formula to calculate the risks of those two currencies. If we had three or more, we need a more sophisticated formula, but for two, this will do the job. Okay, you can see by the way the formula is written, the W's are the weights, what proportion of our portfolio is in that currency. The sigmas are the sigma squared rather is the variance for each asset, whatever it may be. And then over here we have sigma, just plain sigma is the standard deviation or volatility. And then core, we're calling it a core, is the correlation between X and Y. We're going to need that setup for our value risk methodology, by the way. So in other words, what you're seeing here is taken from a branch of finance called modern portfolio theory. Okay, this was invented by Harry Markowitz in the early 50s, and he did eventually win the Nobel Prize for his contributions to the science. So this is a huge deal right here. All right, the value risk is sort of piggybacking off of modern portfolio theory. Okay, so and then here they're just kind of explaining in English how correlations between the currencies in our portfolio will affect our risk. In other words, you'll see pretty soon that when you have portfolios in an assets in a portfolio, ideally you would like the correlations to be low or if possible even negative, because that means you'll get a lot of risk offset. If you have very high correlations, it means the two are more or less the same asset for all practical purposes. And so that means having them in your portfolio will not do anything to reduce your risk. So here it is. So transaction exposure can be measured based on this value at risk framework. So let me give you a brief historical background here. So notice, where did this come from? So throughout history, one of the biggest challenges of managing risk was this. Um, each asset class, and that could mean, for example, stocks or bonds or currencies or whatever, typically has its own unique risk measure. For example, uh, this is Teams. I have Microsoft Teams in this thing, and for the life of me, can't figure out how to get rid of it. But anyway, for example, the risk of stocks can be measured with their beta, or a measure called beta. Right? The risk of bonds can be measured with a measure, I guess, called duration. Now, here's the thing: the drawback to these measures is that they are not directly comparable to each other. But why is that a problem? In other words, it's kind of like imagine if we had two people and what would be a good analogy here? If we had, let's say, or even something as simple as temperatures in two different units, like Celsius versus Fahrenheit, you have to convert one into the other before you do any actually calculations on them. So the problem here is that if an investor held a portfolio of both stocks and bonds, which is often the case, it was not feasible to combine the betas of stocks with durations bonds, come up with a single risk measure that represented the risk of the entire portfolio. All right. So in other words, if I wanted to know how much risk am I exposed to in my entire portfolio, not just the stocks by themselves, not just the bonds by themselves, but the whole thing, it wasn't really possible to do that until value at risk came along. Okay. So in other words, you had to treat them as separate types of risk. And that's kind of awkward because we know that when we have a bunch of assets in a portfolio, it's not enough to know the risks of the individual assets. We have to, at some point, understand how closely related they are to each other, which is typically measured with their correlations. So the value of risk framework, and often you see this abbreviated VAR, was invented in 1994, actually, at JP Morgan. Okay. Now, the motivation here, VAR was created to not only possible for the exposures of different traders, you can see what the problem is here. Imagine you've got a bunch of traders working for you. Some of them are trading stocks, some of them are trading bonds, some of them are trading currencies. It's hard to say, at the end of the day, all these traders are exposing us to X risk because you couldn't really compare them to each other. Okay, you know how it is when Wall Street firms, the trading desks tend to be separated from each other so that one's team is only doing stocks and one is only doing bonds and one is doing currencies and that type of thing. So you might know how much the equity traders risk is. You might know how much the currency traders risk is. You might know how much the bond traders risk is, but you don't know how much all of them collectively are exposing us to risk. So that's what the point of this was, to make it possible to compare the exposures of different types of assets. But in addition to that, the measure is relatively simple. I mean, in a lot of ways, it's very basic. It's not terribly complicated. At least it's drawn from portfolio theory, and it's just sort of like an extension of portfolio theory. So in other words, to make it possible to explain to non-specialists how much risk they're exposed to. So in other words, they're thinking in terms of their clients and also senior management. Imagine yourself trying to explain to the big boss, we have this much exposure to all these different securities. And the boss is, he's an engineer, let's say. So he's a smart guy. He's got the math, but he doesn't know the first thing about finance. Okay, so we have to have a way of easily explaining to him what's going on here. And so this is part of the motivation for doing this. But here's what JP Morgan was smart. They didn't try to make money by selling this idea to clients. JP Morgan, basically what they did was they said they offered the framework, well, it's actually software is what it was, to their clients for free. But here's where the clever part was. Implementing a value risk system requires a substantial amount of data. So they would say to their clients, listen, we got this wonderful new value risk system that you can use for free on the house, but it requires a lot of data. And guess what? Morgan was prepared to sell them that data. So JP Morgan hoped to earn profits by selling data to the clients who were using the value risk framework. That was their motivation. It's not the framework itself that's valuable. It's the ability to sell data to the clients because they need it. You need a lot of data to make this thing work. So while it's relatively simple, it does require an enormous amount of data. And in fact, so much so that it's terribly time consuming to calculate value risk for a company that has a large amount of portfolios that they're managing. In fact, I actually worked briefly at a German bank named Westdeutsche Landesbank, and I was in the risk management group. And what would happen is the company, although we were in New York City, the company was, of course, headquartered in Germany. And so what would happen is, in order for the American traders in New York to have access to the value risk data in the morning, like 8 o'clock, 9 o'clock, whatever, the computers in Germany had to run overnight just to get all the numbers ready for the morning trading session in the United States. So, it was a big ordeal. And if you get involved with starting value risk, you'll see that a lot of research is dedicated to finding ways to streamline these requirements because it's a lot of information that's needed. And a lot of this information isn't always available because not all assets in the economy trade as frequently as stocks. In particular, options tend to trade not nearly as often as the underlying stocks. In fact, certain options can go days at a time without ever being traded. So what do you do now? If you don't have daily trading data for all your assets, you've got to do something about it. So it's not even enough to have information about all of your assets, their volatilities, for example, but you need to estimate the correlations between them and all the other assets in your portfolio. So it's a huge computational burden. Now, of course, this is 30 years ago. Computers have gotten a lot faster since then, but still, it's a big undertaking. So now eventually, I don't know why, but JP Morgan later sold, I guess, the rights to value at risk to an independent company called Riskmetrics. Okay, now Riskmetrics, one of the good things about Riskmetrics is that they published a lot of research about value at risk, and they made it available for free to the public. It used to be possible to get online and say, oh my God, what do they have now? I'm interested in this subject. Now, eventually, Riskmetrics was bought out by Morgan Stanley, and I believe they still own it. And all of a sudden, there goes bye bye to the free research reports. Okay, but it's a very interesting, history here. And now, value at risk is designed to measure market risk. Of course, what else would it be? But it was soon clear that there's other things we could do with it. All right. Oh, sorry, I left out a word here, to measure market risk. In other words, if I have a portfolio of stocks, I want to know how much exposure I have. How much could I lose, let's say, over the coming trading day? So, on the other hand, later, value at risk was extended to measure credit risk. Now that's a little bit different because now you're trying to figure out how much your portfolio could lose if some of your bonds, let's say, either go bankrupt or they're downgraded, whatever the case may be. And then they extended it to all these other directions, but originally value at risk was intended for one reason and one reason only, to measure market risk. Okay, credit risk is a very different ballgame. You don't get that with currencies, but you really only have to worry about it for bonds, let's say, or any other types of securities that involve a loan. So it's a very specialized type of VAR. And so anyway, it's ultimately VAR is based on it's called modern portfolio theory, which was developed by Herman Markowitz in the early 50s, which won him Nobel Prize. I think he won his prize in the early 90s. They take a long time. The thing about the Nobel Prize in economics is that you can think it was a lifetime achievement award. They don't normally give it out for a single accomplishment or something important. It's usually thought of as like your lifetime's work is what is winning you this prize. So anyway, so we'll see how it's related to portfolio theory. For example, the framework assumes that the returns to assets are normally distributed. We'll see a lot of that in a few minutes. And well, there's other assumptions as well, but this is one of the most important ones. Okay. It also assumes that investors are only interested in rates of return and risk as measured by the standard deviation. So any other information is not relevant, according to this framework, to investors. So in other words, people are saying, well, what rate of return am I being promised? And how much risk is involved? And that risk is being measured by the standard deviation or volatility. And there's many other assumptions, but so the framework is it's been around for like obviously 70 some odd years, and it's very, very useful, but we have to be aware of these assumptions and what impact they have on our results. But anyway, so you'll see how at the heart and soul of value at risk is Harry Markowitz's framework, but then they've extended it so that suddenly it becomes possible to have a single number that says this is how much risk my entire portfolio has. So this is what we're aiming for. So value at risk was the first made it possible to have a single risk measure or an entire portfolio of assets, regardless of what assets they are. In other words, it doesn't matter if they're stocks, or bonds, they're currencies or commodities. We can lump them all together into one big risk measure. And that's the beauty of it. Okay. So we have a single number that was never possible before. Now, of course, we have to take it with a grain of salt because it is based on a lot of very strong assumptions, but that's to be understood. With any model of any kind, the whole idea is that a model is a simplification of reality. And so the more assumptions, the more we have to keep an eye on. In other words, the more salt we have to take with it. In other words, a grain for some assumptions, maybe a tablespoon for others. So, but we'll see that as we get into this. Now, with all that being said, the value risk framework is attempting to measure how much a portfolio or asset, a single asset, or entire portfolio of assets could potentially lose over a given time period with a given level of confidence. Now, you may have run into this in statistics. You may remember the idea of confidence. That's essentially where we're going with this. So typically, the confidence level will be 90%, 95%, or possibly 99. Right? Those are the normal ones. We might see others too, but those are the ones you normally run into. And then this level is chosen depending on how conservative you want your portfolio to really be. And so the results are found are based on, I should say, the normal distribution. Now, again, if you've had statistics, you know that the normal distribution is this bell-shaped curve. So let's say in the center, we have the current value of your portfolio. We'll call it V0. What we're looking for is, let's say here, I'll call this X. Let's say this represents the left 5% tail of my distribution. So the value at risk at the 95% confidence level is actually the distance between those two. In other words, how much might I lose compared to today when I'm sitting in the center? That's the value of my portfolio today, V0. Yeah. X is the worst case scenario, basically. So anyway, so how far can the portfolio fall? Let's say over the coming trading day. That's what we're trying to measure. And that's with 95% confidence, which means we're still a 5% chance that we're wrong, but this is what we're trying to capture. Okay. So you can see that it is based on the normal distribution, and we're focused on how much might we lose in, let's say, the worst case scenario. Now, it's got, value risk has a lot of issues, but a lot of research has been conducted to try to find ways of improving it. And there's some progress going on. There are ways we can improve this without relying so heavily on assumptions. But usually what ends up happening is that in order to get rid of these assumptions, we need to replace the normal distribution with something that is so horribly complicated that it calls into question whether or not it's worth our while to bother. In other words, you might say, well, if we'd only try this other distribution, it might work better, but you might find that it improves your results by just a few percent compared to making twice as much work for yourself, let's say. So that's why we consistently keep using the same framework, even though we know that it has issues. Anyway, so here they are showing you an example with currencies. Now, this is supposed to represent the expected value of our exchange rate. And this is the standard deviation. I think this is meant to be the Mexican peso. This is the volatility of the Mexican peso. Now, the 1.65, that we will have to discuss in a bit. We'll have to take a step sideways, basically, to explain why 1.65 is being used here. Okay. And it has to do with the properties of the normal distribution. Once you've got all this set up, now if you notice, this formula looks awfully familiar. I mean, it's just the Harry Markowitz formula for the risk of a two asset portfolio. So in other words, the value at risk itself is based on the same formula. Let's see. Now they're telling us, well, you know, if you wanted to do this in a spreadsheet, and we're going to actually do it in a few minutes, you could. These are, in fact, you know what? I'll tell you what. Maybe later on we will. This chapter 10 spreadsheet that I had set up, chapter 10 data. I don't think we actually ended up using it for anything. Maybe later on we'll try that. But right now, my first example, because the original value risk framework was based on stocks, we're going to have an example with stocks first, just so you can get a feel for how it works. Then, if we have time, we'll switch over to currencies. Okay. So here is your spreadsheet. It's on no, this is a separate one. This just says chapter 10 data. So here, oh, here it is. All right. So this is the one we're going to fill in tonight. So now let's see what's happening here. We've got 10 years worth of stock data. And we've got the closing price at the end of each of these years. And we got a dividend. All right. So if I own this stock, I'd like to know, first of all, what kind of rate of return am I getting? So here in this column D, we have the so-called holding period return. Let me make a note here somewhere that HPR stands for holding period return. And how do we calculate it? Well, what we need to do is take into account the fact that we collected a dividend and how much the price went up in percentage terms. All right, so you have your spreadsheet open right there. The formula we need is, so I'm just going to steal it from my own spreadsheet here. This is what we're looking at. It's B3, which is the current price of the stock, plus the dividend here at C3, minus last year's closing price, all divided by last year's closing price. So in other words, what it's telling me is that I lost $4.57 on the stock price, but I also made back $2 from the dividend. And so as a percentage of the original price of $99.72, I lost about 2.5%. Now, the beauty of this setup is that I don't, oh, what's happening? There it is. All right. Oh, you only have to type it once, okay? Once you're done, you can just drag it down. And this is what you should get. This is your time series of returns over the last 10 years. And you can see, well, this stock didn't do terribly well. I mean, no, it's not awful, I suppose. It depends on what period we're looking at here. But so the expected return is another name for the average. So I want to know on average how well I did over this 10-year period. These are the individual years returns, but I need to average that out too. And so I'm going to do that here with the command average. All right, and that means on average, I made approximately 3.5% per year from the stock. Nothing to jump up and down about, but you know, It could have been worse. How do we know there weren't a bunch of recessions during that period? I mean, really? All right, so then now the variance and standard deviation, we're going to use Excel's built-in commands. But we have to be careful because Excel makes a distinction between the variance of a sample and the variance of a population. Whenever we have time series data like this, we almost invariably treat it as a sample. Okay, so like in other words, unless the stock was only first issued in 2009, that means what we have here is a sample. So the command is var.s, and that's going to tell me the variance of the returns. But what I really care about is the standard deviation. So how do I do that? So I'm going to drag it down. Whoops, too far. This number is my vol. Wait a minute. No, sorry. I don't want to drag it down. I just want to take the square root of this number. That's better. Because if you remember from statistics, the standard deviation is simply the square root of the variance. About 3% per year. So that's your standard deviation or volatility, as it's sometimes called. So you have your expected return about 3.5%, followed by your standard deviation of about 3%. Now we'd like to do the same thing for this other stock Q over here. Now you should, in principle, because of the way it's set up, be able to copy this directly as long as all the columns are lined up correctly. You won't have any problems because if you look at it carefully, you'll see that you've got the current stock price plus the dividend minus the old stock price divided by the old stock price. This is how we calculate the holding period return for a share of stock. So this worked out just fine. We'll drag these down. And while we're at it, you can actually copy these formulas too. No problem. Because you can see they worked out fine. The average of G3 through 12, the sample variance, and the square root. Beautiful. Now, if you notice, as we would have expected in an efficient financial market, the first stock has a lower return, but it also has a lot less risk. Okay, quite a bit, as a matter of fact. So when you decide which one to buy, you got to take those both into account. You can't just say, well, I'm going to get the highest expected return. The reason why that's not a good move is because that also carries with it the highest risk. Now, I'd like to know the covariance and correlation between my two stocks. Again, the covariance does, the formula does depend on whether this is a sample or a population. So let's put covar.s and, oh, I'm sorry, that's not how it's spelled. It's covariance.s. And then you open the parentheses. Now it says array 1, array 2. They mean to do this. Select the stock V returns, comma, stock Q returns. And then when you hit enter, you'll get your covariance. Now the covariance has, and you see it's very close to 0. The covariance is a useful measure up to a point, but the problem with it is that it's hard to judge what it means. In other words, I'd like to know how closely these are related to each other. By the way, let me show you a special trick we can use to identify or measure how closely related these returns are. What we could do is we could create, let's see. The problem here, the way it's set up, is these dots are here because you need 2 years worth of data to calculate a single year's holding period return. So here, for 2009, I don't have the previous year's data, so I can't put anything here. But that's going to make it impossible for me to draw a graph in Excel without making a mess out of it. So what I'd like to do is copy these two headers somewhere else. So I can do exactly that. Okay. Now, the data itself, I can copy it, but I have to be careful. I want this set of data, just the returns, not the asterisk. Hit Controller Command C, come over here. Now don't paste it. Instead, hit paste special values and formats. The difference between the two is that here these are formulas. And here they're constants. So if I had copied and pasted it, the numbers would have been changed. They would have been wrong because they're not in their correct location. So that's why this is necessary. I have to not only copy it, but I have to paste special it to make sure that I only get the values, not the formulas. Same thing over here with HPR for stock Q. Let's select these. Let's hit Controller Command C. And over here, just paste special values and formats, number formats. Ah, there it is. Now, what am I going to do with this? I'm going to create a scatter plot, which means come up here, insert, and you look over here under charts, you'll see right here, these are scatter plots. So let's choose this one. And there you go. Now, there isn't that much data here, so it's hard to judge what those dots are telling me. So we really were trying to find out how closely related they are to each other. Do they tend to move up and down together? Do they tend to go in opposite directions? Are they just plain unrelated to each other? So what I'm going to do to visualize this better is I'm going to right click one of these points, and then I'm going to ask it to add a trend line. Now, also while we're at it, let's ask for the equation. And so here's the trend line. Now you notice it's an almost perfectly flat line. The slope is 0.0756. So for all practical purposes, the two variables are not really very closely related to each other. There's a slight positive trend there, but it's very, very weak. It looks like the two stocks are largely independent of each other. Now, we'd like to follow this up further by calculating the correlation, which will tell us, give us a number that makes it easier to interpret it. So it's spelled correlation, based on stock V's HPR and stock Q's HPR. Now, 0.0375. Now, what does that tell me? Well, let's go back to our Word document for a second. So correlation itself is always going to be somewhere between positive and -1. Okay. We often see it designated with the Greek letter rho. So rho is bounded between positive and -1. It cannot go outside that range because of the way it's defined. Our job is to figure out how to interpret it. So if I were to create scatter plots for different values of rho, here's a good example. If you notice, there's a very strong positive trend line between the two. In other words, the points are very close to the trend line. That means X and Y are very highly correlated with each other. So let's just say in this case, the correlation is 0.9. Now, here's a case where they're positively correlated, but not nearly as strongly correlated. The points are pretty far apart from the line. So here, let's say this is equal to 0.3. It's still positive, but very weak. Okay. Then in the intermediate case, I could have a case where they're two more or less independent of each other, which means the points are more or less scattered all over the place. So therefore, the trend line would be flat and the correlation would be 0. Here, they're independent of each other. But then we still have the possibility of variables moving in opposite directions. Okay, so what would that look like? Well, there's a couple of possibilities. First of all, we can have a very strong negative relationship like this. Say this is the case of negative 0.9. And then finally, we can have a very weak but negative relationship where the points are facing, I mean, they're going down, but they're not, the relationship is quite weak. Points are scattered all over the place. Let's call this negative 0.3. So it's pretty easy to look at a correlation coefficient and determine how strong the relationship is between X and Y, as well as the direction. So it's very useful information. So here we're really very close to zero. And so that means that our two variables are pretty well independent of each other. Now, is that good or bad? All right, I'll tell you why. If you look at this formula, this, by the way, represents the risk of a two asset portfolio. Here we go. You know what I've noticed? The recent trend on my computer here is that whenever I'm using a Microsoft product and I do, routine procedures, it often comes up and says, "Hey, how'd you like Copilot to do that for you?" I think they're pushing that product pretty hard. Now, of course, like most people, I don't have the slightest idea what it actually does. I just know that it's supposedly an AI product. So one of these days, when I have time, I'm going to learn how Copilot works, but just not tonight. So that formula, if you look at it carefully, represents the risk of a two asset portfolio. Here's the correlation coefficient. So you can see by this formula, the lower is the correlation, the lower is the risk of the entire portfolio. So, just algebraically, you can see that. So in terms of economic logic, though, um, a low correlation means that assets are affected by different variables for the most part. In other words, for example, we might find low correlation between Apple stock and General Motors stock. Yeah, I guess that's a pretty good analogy because Apple is really a computer company, although they make software too, and General Motors is a manufacturer company which makes autos. Um, then let's say Texaco and ExxonMobil. Since Texaco and ExxonMobil, of course, are both oil companies. So ideally, when choosing assets for a portfolio, by the way, when it comes to currencies, for currencies, we would expect a high correlation between, let's say, let me think of a good example of this. Dollar euro exchange rate and the dollar Swedish krona exchange rate. Because Sweden obviously does a large percentage of their trade with the European Union, Eurozone members, I should say. Okay, so Sweden, although it's an independent country, they tend not to join any of these international organizations. Sweden does a great deal of its trade with the members of the Eurozone. Okay. Therefore, Sweden's business cycle is highly correlated with that of the Eurozone. And it stands to reason that the currencies will be highly correlated. Okay. On the other hand, we would expect a low correlation between, let's say, the dollar yen exchange rate and the dollar Swedish krona exchange rate. It's not that they don't trade with Japan. It's just that it's not nearly as much as they trade with Europe. So the business cycles in Japan and Sweden would tend not to be as highly correlated with each other. So when, as an investor, when you're choosing assets for your portfolio, an investor who wishes to minimize their risk can diversify their portfolio by choosing assets with very low or possibly negative correlations. That would be the ideal. Now, it's not always possible to do that. I mean, for example, in the US, any American stocks you buy are going to have some correlation between them because they're all affected by the same business cycle. It can't be avoided. In fact, I saw a survey somewhere where that said that the average pair of American stocks has a correlation of 0.33 because the fact that they're all exposed to the same fundamental economic risks. So if I want something lower than that, I may have to go find something completely different in a foreign country, let's say. So in other words, an American stock and let's say Japanese stock or something like that. So this formula then is going to tell me how much risk I have in a two asset portfolio. And we can see that that risk will be lower if I manage to find assets that have lower positive correlation, sorry, negative or very small positive correlations between them. By the way, in principle, I could get rid of all the risk of my portfolio if I find two assets with a -1 correlation between them, the lowest possible one. But that's very, very, very rare. Okay. All right. So now the value risk framework, by the way, takes all of this explicitly into account because it incorporates this formula right here. Okay, this is how it measures the risk of a two asset portfolio. So all of this applies directly to value at risk. And so the value at risk framework is based on the Markowitz's portfolio theory. Oh, actually, I shouldn't have put that there. So anyone who wishes to minimize the risk, any investor, let's say, who wishes to minimize their risk, um, will want to choose assets with low or negative correlations. Okay, so anyway, so let's get back to this. So anyway, so what was the point of all that discussion? That if I put both V and Q into my portfolio, that's pretty good because you can see the correlation is quite low. Lower would be better, of course, but that's, this is fine. Now, let's try this. Let's assume that I own both stocks. 50% of my portfolio is invested in V, 50% is in Q. These are the weights, 50% in Q and V with 100% total. The expected return. Now, how do I calculate the expected return of a portfolio? It's here somewhere. Here it is. I'm going to multiply each asset in my portfolio by its weight. Actually, I'm multiplying the return to each asset by its weight, which is the proportion of the total invested in that asset. Okay. So, for example, here I've got half and half. So I'm going to have 0.5 times the expected return to V plus 0.5 times the expected return to Q. Okay, so the expected return of the entire portfolio is about 3.8%. The variance, well, now this is a tricky one because what you're effectively doing is this formula without the square root sign. So this one is a challenge. Let me type it up quickly and let me show you the formula. You're going to have the weight squared of V rather, times the variance of V, which is up here, plus the weight squared of Q times the variance of Q, plus 2 times the two individual weights, times, use block here, I can see the correlation between them, times the two individual standard deviations. So that represents the variance. Now, I'll show it to you in a second again, but the standard deviation is the square root of this variance, of course. About 3.5%. Now, if you notice, the variance of stock V is about 3.1%. The variance of stock Q is about 6.2%. The portfolio variance is a standard deviation rather, is slightly higher than for V, but a lot lower than Q. And yet the rate of return is higher than it is for V, although lower than for Q. So what I've done is I've found a way to get a rate of return that's halfway between these two, and yet where the risk is very close to this safer stock than to the riskier stock. That's because the correlation between the two is close to zero. What I'm seeing here is a diversified portfolio, and the risk reflects that. Okay, so now let me show you this formula again. And you can see it's a lot of typing. Let me give you a couple minutes to catch up. And then for the standard deviation, all you have to do is take the square root. So I'll just sit here and wait. I'll let you know what's coming next. And when you're done, don't forget the standard deviation is simply the square root of the variance. By the way, I'm going to post this on Brightspace. So if you missed something, you can go back and catch up. But all right, anyways, so once you're done that, in cell D5, put equals the square root of cell D24, and that's how you get that 3.5% there. Once that's done, that's where almost all the hard work is going to come from. The rest of these numbers we'll see as we go along are really relatively straightforward. Okay, so you should have approximately 0.001262. Now you take the square root, and you have roughly 3.5% per year. Now, the value at risk formula itself is shockingly easy once you've got all this in place, because all you're really doing is, now, by the way, in this case, we're going to assume that our portfolio is worth $1 million. Half of that is in stock V's, half of it in stock Q. This part requires a little explanation. This is based on the properties of the normal distribution. So why don't we take a detour here? We're going to calculate VAR at the 95% level of confidence. Okay. What does that mean? So remember, now value at risk, as I showed you earlier, is based on the left tail of this normal distribution. So if you were thinking in terms of the standard normal distribution, which is what this is a special case where the mean is 0 and the standard deviation is 1. So it turns out, and you can calculate this in Excel if you want to, that the bottom 5% of, or lower 5% in this distribution is here. So 0 is the mean, so we'll write it like that. And this number we're looking for the bottom 5% is bounded by, this stands for the mean. Actually, let me write it like this. 1.645 standard deviations. So let's say that you are not the tallest person in the world, and you're told that you were in the bottom 5% of all people. Okay. You're just not terribly tall. So that means your height puts you 1.645 standard deviations below the mean, which means you're in the bottom 5%. Or let's say you really bombed a test and you're told that your score is 1.645 standard deviations below the mean. That would be bad news because it means 95% of the class did better than you and the only 5% did worse. So all of this is taken from the direct properties of the normal distribution. So that's where this number is coming from. This is the important thing here. So that is part of our formula. Let's go back to the spreadsheet and you'll see, yeah, there it is, 1.645. Okay. Now we need the standard deviation that comes next, so we can just copy it here. The product of these three, in other words, the $1 million times 1.645 times the standard deviation is 58,440.49. Now, what does that mean? Well, let's go back to our value at risk graph. Let's see, let's go back. Here we go. So I'm going to rewrite this in terms of dollars. The portfolio is currently worth $1 million. And this number that we just calculated, 58,440.49, means that 5% of the time, I might lose up to this much money or more, as it turns out. And that means the portfolio value would drop all the way to it's about 941,000, 559.51. This is the bottom 5% of the distribution. So in other words, my losses on a particular, let's say year, in this case, it's years, for the trading year could be 58,440.49 or possibly more than that. Okay. So that means the portfolio could drop down to 941,559.51 or maybe lower than that. That's based on a year. Now, what if we're not interested in yearly gains or losses? What if I'm looking at a smaller time frame? There are ways we can adjust for this. So monthly VAR means you're taking annual VAR, as you can see with my handwritten notes here, and dividing by the square root of 12 because 12 is the number of months in a year. Okay. So that's going to give you the monthly VAR. How much might I lose every month rather than every year. About 16,870. Now, here's the interesting part. For daily, I'm not going to divide by the square root of 365, but instead 252 because we're going to assume that's how many business days there are in a year. In other words, we don't want to count holidays because these securities do not trade during holidays or weekends for that matter. Okay. So we're going to divide by the square root of 252. That's an assumption we're going to make. Some books use 252, some use 250, some use 255. They're all different. So it's about 3681.42, 40. So that means every day potentially I could lose this much at the 95% level of confidence. Now, there's these other measures that we can use too that are related to VAR. Um, Let me go to my answers for a second here. Just so you can see what these numbers are supposed to be telling us. Oh, this one worked. This one doesn't seem to have worked. I wonder why not. Oh, wait a minute. Oh, you know what happened here? These numbers were supposed to go over here. I see. I misunderstood. All right. Sorry about that. Let me show you what was supposed to happen here. I forgot that we were supposed to have these same three measures for stock V, stock Q, and the entire portfolio. This is what we were doing before. So um, let me just quickly show you what you would need to do to fill these in. So these we've already done. All right, we did this earlier, although we accidentally did it in column D because I didn't look at my notes. But this is how these you're just literally copying them from above. So this won't take you but a minute to fill them in. Just the only reason we're doing this is so that they're all visible together in the same place. So I can compare them side by side and take a look and see how the returns compare to each other and the portfolio, as well as the standard deviation and the variance. All right, so why don't you make that change? I'll try to make it a little bit more narrow. There you go. All right, so this is what we need right here. All right, so remember these are the same ones we typed a few minutes ago, but in the wrong column. So these you can just replace with these three. And if you notice down here, the ones that we're about to go over are now all correct. All right, so these are numbers you should have. Now down here, move this away a little bit. So these are the VARs for the individual stocks. You can calculate the VAR for single asset as well as an entire portfolio. So I'll tell you what, let me show you these formulas. You can put them in your spreadsheet and then I'll explain to you what they mean. All right, so right now, let's focus on these. Ah, All right, I'll give you a couple of minutes and we'll see what the numbers actually represent. All right, so let's see what these numbers mean. So VAR V by itself has a VAR of 25,581 as and Q is about 51,000. Now, what I've done here is I've added these together. And if you notice, by doing that, I end up with something called undiversified VAR. That is what your VAR would be if the correlation between V and Q is at 1. Okay, and when that's 1, it means you're getting no benefits of diversification. Whereas up here, the actual VAR we got was 58,440. So that means that could only happen if we have a correlation less than 1. So the difference between these two, which is called the benefits of diversification, 18,734.58, means this is how much risk I reduced my portfolio by choosing stocks that are not perfectly correlated with each other. So it's sometimes called the benefits of diversification. So I congratulate myself for reducing my risk by choosing the right stocks for my portfolio, right? If I picked two that have a positive 1 correlation, I would have ended up all the way up to 77,175. Okay. So that in a nutshell, there's more stuff down here about other ways of calculating VAR, but I think we have the basics down here. So, you should use this portfolio, this spreadsheet to understand what value risk is doing and how is it being calculated for a 2 asset portfolio. Okay, so it's like my present to you that you have this example in front of you that will let you understand better how value or risk works. All right. So, and then I'll also post this discussion here too. Anyway, let's get back to the actual slides for a second. By the way, over here, my notes are essentially covering exactly what we just did. Okay. It's a little bit more involved, but you can go back and read through these and see how this works. But you'll see it's exactly the same as what we just did. So let's go back to the slides that came with the book. Now, because they only really briefly mentioned value risk in conjunction with the transaction exposure. So here they're talking about how you would do what we just did, except with exchange rates. And what they're suggesting is that if you wanted to apply all this to currencies, and by the way, this is one of the reasons why I put this thing together. What they want us to do, though, is they would like us, we're not going to calculate directly on the exchange rates themselves, but we need the percentage changes. And how do you do that? What you have to do is calculate. It's basically very simple. The current value minus the previous value divided by the previous value. All right. So in other words, here the exchange rate went up 2.54% on March 24th, 2020. And then you see how easy this is. You would just drag it down all the way. Wow, there's a lot of data there. Oh, I forgot how much was in here. All right. And then you can do the same thing over here. In fact, all you have to do is copy this column. You don't really have to type anything. Select Control or Command C, paste, Control or Command V. Now, let me show you a special trick with Excel. How do you see the headers and the bottom of these very long columns? You go to the View tab and choose Split. You don't need the vertical one. You can just double click it. It'll disappear. And so now I can separately scroll through the top or the bottom window pane. And what I want, wow, there's a lot of taking. Oh my God, it just never ends. There we go. According to what we're seeing here, we want the standard deviations. Sample standard deviation, that is. So you're going to apply that not to the euros, the exchange rates themselves, but to the percentage changes. So here you'll have standard deviation dot S from row 2. Let's just yeah, there we go. Row 2 to oh no, sorry, 3 to 1306. Okay. Now keep in mind, by the way, these are daily values. So these standard deviations are daily. Normally what you do is you convert these because usually well, not necessarily. You might want daily results, but if you want annual, what you're going to do is multiply these by the square root of the number of trading days in a year, which is again assumed to be 252, about 8.82% on an annual basis. Over here, it's about 7.34%. So it just means that the pound at the moment, at least, is somewhat more volatile than the euro. Okay. Now, what do we do with this information? Oh, by the way, we also need the correlations between the these two. Pretty high. And you can see why. I mean, clearly Britain does a lot of their trade with the members of the Eurozone. And so naturally, their business cycles are closely aligned to each other, and therefore the correlation should be quite high. So let's say I have a portfolio containing $1 million of pounds and euros. In fact, we can set it up just like this one. Except that we still need this part. Okay. So I'll tell you what, let's copy this, or at least use this framework. So how about this time we'll change it slightly? Well, 30% and 70%. And then this would add up to 1. Now the expected return, we don't really need the expected return for what we're doing here. In fact, I'll tell you, let's take it out of there. The variance, and we just got through calculating these, we don't have to worry about it. Let's use the annual numbers. The standard deviation, we just copy it directly. And then to get the variances, we just square them. When you see, by the way, when you see this, it means it's got too many digits or something's not right. I'm going to try that again. I don't know what that is. Oh, it's just a huge number. That's what I thought. And then we'll drag this across. So those are our results. Now, what about the portfolio variance? Well, for that, we need this one again. So this is our standard deviation. So we'll calculate for the variance. And then we'll take the squared. So we'll have W squared times the variance of dollar pound will be asset X plus weight squared here times the variance plus 2 times the 2 individual weights. Yeah, times the correlation between them, which we do have here, times the 2 individual standard deviations. So the portfolio's variance is here, and then we take the square root of that to get something. Oh, that's right. I forgot. So the other ones we did the standard deviation first. So it's the square root of this. Okay, so you can see now this is interesting because the portfolio risk is actually lower than for either currency by itself. Okay, so that's kind of an interesting result. And so we can then calculate the value of risk, the 95% level of confidence, as now remember we saw earlier, actually I'll tell you what, maybe we'll just do this approach. Assume $1 million portfolio. The quantile is 1.645. The portfolio standard deviation is here. Okay. So in other words, we just did the same thing we did earlier, except here instead of they're currencies instead of stocks. So that means over a given trading day, this is how much we might lose. So, and we almost forgot, the 95% bar is the product of these three. All right, so, actually, sorry, this is N. So losses could potentially reach 120,000 over a single year. Over a single trading day, we take this number and divide by the square root of 252. So in other words, on a single trading day, we could potentially lose 75-60 at the 5% level of confidence. 95%, sorry. Okay, so now we have 2 examples of value at risk, one with stocks, one with currencies. And so this way we know that if this risk is unacceptably high, maybe we should try something different. Maybe we could buy some derivatives. There's a lot of things we could do to reduce this risk, but at least now we know how much risk we're exposed to. All right, so the whole purpose of all this was to figure out the VAR of our portfolio, which shows us how much transaction exposure we're exposed to. Okay, well, I hope you found that interesting. So then they're going to move on to something a little different. They're going to discuss the limitations of VAR. Sure, quite a few. We have economic exposure, which means how much of the cash flows themselves are going to be affected by exchange rates. And, they're trying to help us with this chart showing us how much, what will be the effect of either the dollar depreciating or appreciating. Okay. Now this, see what they're saying here is they're like last week when we were forecasting with regression analysis, we could do something like that too. We could try to figure out how sensitive our cash flows are to changes in the exchange rate with a regression model. Now, we can't do that here because we don't have a corporation's cash flows, but we have seen how regression analysis works. You'll end up with an equation whose slope tells me how much each, let's say 1% change in the exchange rate will impact the value of our cash flows. So this is one thing we can do. Um, we can actually simply use, instead of value risk, we can use a regression model, which shows us how much the exchange rate will directly impact on our cash flows. All right, so we won't be able to do that here, unfortunately, unless, well, what they did here was scenario analysis. They basically showed us how, for example, the US sells, the Canadian sells, the cost of materials in the two countries, interest expenses, and how they would be different for different Canadian dollar exchange rates. In other words, here, one Canadian dollars, 75 cents US, 80 cents here, 85 cents here. And so these are the three resulting cash flows. And you can see in this case, we'd like ideally to have the Canadian dollar be worth only 75 US cents. Okay, not 80, not 85, but we want this scenario. So if we have reason to believe that that's the one that's most likely to occur, we can feel comfortable that our situation may not need to be hedged because we're expecting the best case scenario. But if it's going to be one of these other twos, we may want to do something about it. Wow. Okay. So now, then we get involved with accounting methods, et cetera, et cetera. All right. Now, now that really appears to be their entire discussion here. They don't seem to have anything else for us. All right. Well, you know what? I think I'll tell you what, let's take a look at our assignments this week and see if there's anything we overlooked. I'm going to go into Cengage. I want to get a sense of what they're going to ask you to do this week. And if there's anything we overlooked, we can maybe do it now. All right. Okay. So this week, remember, you're doing chapter 10, which we just finished there. So they expect you this week to do this assignment. I just want to get a feel for what they're asking to do. All right, this is a conceptual question. You can do that. Here, you're just calculating the dollar value of the pounds under these three different scenarios. And then based on your expectations, they're asking whether or not it makes sense to hedge your risk. Same thing, you're filling in this chart based on these exchange rate assumptions. And I think that's all they want you to do here. Oh, you're okay. We have oh, this is value risk. Okay, good. These are simple examples of value risk. They're not asking you to do all the, the calculations like we did from the historical data. They're giving you some of these numbers and they're asking you to calculate the values at risk. Okay. By the way, I do want to point out, though, it looks like they may be doing something a little different. If you were to, when you calculate this value at risk, this is your dollar value at risk. If you only are interested in the percentage change in your portfolio, you can calculate percentage R as quantile times portfolio standard deviation. In other words, you leave out the dollar amount. So if we wanted that here, 95% percentage VAR on an annual basis would be just this product right here without the $1 million. And then, of course, as a percentage, that's almost exactly 12%. And then to make that, oh, I forgot to put in the word annual. And then 95% percentage. Actually, I probably should have called it annual percentage VAR. Hold on a second. Sorry, it sounds better this way. Annual percentage VAR. And then to make that into daily, just like before, you would just divide this by square root of 252. Okay, well, so I'm glad that we looked that up because now this information will be at your fingertips. And then that was number 4. Number 5, economic exposure. So they're trying to make sure you understand what would happen if you're exposed to Mexican pesos. What happens if the peso depreciates or appreciates? What happens to the cost of your imports and the value of your exports? So you can do that. And then all right. And again, you're just, this is like the chart they had in the slides. You're filling in all this information based on the current exchange rate in each of these columns. So you can compare them with each other. And then you're going to be asked to draw some conclusions from them. And then down here, it looks like this is also a conceptual question. All right, I think you're all set then for these assignments. But I'm going to, of course, post all these results tonight as soon as we're done. So you can go look at them as you need to. And then that way you shouldn't have any trouble doing this week's assignment. So next week we'll pick it up with the next chapter, which is 11. And then we'll take it from there. Okay, so in other words, we didn't have a break, but we don't need one because we're already done. So I guess we'll just stop here and I'll see you next week. Okay? Very good.
Good night. Thank you.
All right, good night. Bye. Bye, everyone.